This year alone, the biggest tech companies in the world are on track to spend $725 billion on artificial intelligence. To put that number into perspective, if you spent $1 million every single day from the birth of the Roman Empire all the way to this morning, you still wouldn't hit it. Big tech is committing about $23,000 to AI infrastructure every single second. Right now, half the internet is screaming that AI is a massive financial bubble, and the other half is convinced it's the greatest technological leap of our lifetimes. But if you look closely at that debate, both sides are fixated on the exact same metrics: user growth, daily adoption, and top-line revenue. The problem is, demand is an incredibly noisy metric. It is entirely driven by narratives, which means the numbers shift depending on who is telling the story and what they are trying to sell you. More importantly, demand can be faked. Millions of investors are fiercely debating a metric that is specifically designed to deceive them. If you want to know what is actually unfolding in the markets, you have to look at the side of the equation that requires hard evidence. In the 1990s, tech companies faked demand by lying about their web traffic. Today, AI giants are doing it with money. There is a deeply interconnected financial loop driving the AI industry, where the biggest players are essentially passing the same pile of cash back and forth to create the appearance of explosive growth. Here is how the loop works in practice. NVIDIA injects funding into OpenAI. OpenAI then takes that capital and uses it to pay Oracle for cloud services. Oracle then takes that exact same cash and uses it to buy more chips from NVIDIA. By the time the cash arrives back at its starting point, it has passed through 3 different corporate ledgers. And every single time it changes hands, it gets logged again as somebody's brand new end-user demand. This financial sleight of hand is called vendor financing. Equipment makers lend their own customers the cash to buy their gear, and then book those sales as revenue to support sky-high valuations. It is the exact same tactic telecom giants like Lucent used to prop up their own growth numbers right before the dot-com crash. You can manufacture demand to keep the chips moving and the stock prices rising, but you cannot fake supply. Supply takes hard, irreversible capital committed upfront. To find the truth, we have to look at what is actually being built. In the 1700s, Adam Smith laid out a very simple economic rule. When a new industry shows perceived high returns, capital naturally floods in to chase those profits. That sudden flood of money guarantees a massive spike in competition. That idea has evolved into what modern economists call the capital cycle theory. It cuts through the noise of consumer demand and maps out how an intense rush of competition inevitably drives returns into the ground for everyone involved. The cycle always moves through an industry in 4 distinct steps. First is the flood, where a shiny new technology appears and capital rushes in to capture the initial gains. That leads directly to the boom. Investors keep throwing money at the space, and competitors pile in much faster than actual user demand can grow. Eventually, all that new supply crushes the very returns that attracted the money in the first place, triggering the collapse. Prices plunge, builders go bankrupt, and the original investors are wiped out. That leaves the final stage, the inheritance. The surviving companies walk into the wreckage and buy up all the underlying physical assets for pennies on the dollar. This pattern has emerged across every major technological shift of the last 2 centuries. In the 1830s, investors bankrupted themselves, laying out massive railway networks that they ultimately had to sell for scrap. We saw the same pattern with the thousands of miles of unused fiber optic cables buried during the dot-com bubble, and the wave of over-drilling during the shale oil fracking rush just a decade ago. Regardless of the century or the technology, the results are the same. The people who bankrolled the initial build-out were destroyed by the oversupply they created. When we apply the capital cycle to the artificial intelligence industry today, the money is still pouring in, but the math is catching up. We are sitting right at the terminal edge of the boom phase. Look at the recent market shock surrounding Broadcom. In early June, the chipmaker beat its earnings, but guided its future AI sales just a few $100 million lighter than expected. In a single trading session, $300 billion of its market value vanished. When a rounding error in future guidance can erase $250 billion in a matter of hours, you are looking at a market priced for a single flawless outcome, where any hint of slipping returns triggers immediate panic. You can see the exact same margin compression happening at the software level. OpenAI's recently leaked financials show a staggering $38.5 billion loss for 2025. More tellingly, they are now spending 44% of their entire revenue, about $5.7 billion, on sales and marketing just to keep people using their product. The cost to acquire customers is skyrocketing at the exact moment the base technology becomes commoditized. These collapsing profit margins perfectly mirror the historical warning signals of a capital cycle crash. There is an old business proverb that dictates how this cycle resolves. The pioneers get the arrows, and the settlers get the land. The first movers into a new market absorb all the initial resistance and take all the losses. In the mid-90s, early search engines like AltaVista burned through millions of dollars building the very first web crawlers. They bled themselves dry figuring out how the technology worked, which allowed Google to walk in later, avoid their expensive mistakes, and capture the market. We saw it again with ride-sharing. A company called Sidecar spent years tied up in court, absorbing the brutal legal battles and regulatory fines that made the entire gig economy possible. While they were trapped bleeding cash, Uber was able to simply copy the model and conquer the space on the foundation Sidecar had paid for. Right now, the massive tech conglomerates pouring $725 billion into server farms and energy grids are playing the role of the pioneer. They are fronting the massive capital requirements to prove that the market exists, taking on the concentrated financial risk of the first mover. When this massive wave of investment finally corrects, it will not mean that artificial intelligence was a useless technology. It simply means the economic cycle is forcefully resetting to punish the oversupply of hardware and language models. The true winners of the AI revolution won't be the companies currently exhausting themselves to build it. The real fortunes will go to the silent second movers, waiting to inherit the wreckage for pennies.